Welcome to Investing Lighthouse, where we explore the world of investing in the stock market. In the past, the New York Stock Exchange trading floor was the quintessential image associated with stock trading. Traders would gather in person to negotiate deals, shouting out prices and tickers across the bustling trading floor. However, as technology has advanced, trading has shifted towards an online realm, enabling everyday individuals to try their hand at making money from home. But it's essential to note that trading is distinct from investing. While trading can be profitable, it's also a complex and high-risk activity that may not be suitable for most people. In this video, we'll delve into why this is the case and provide insights into the world of trading. When it comes to finance, trading and investing are often used interchangeably, but they are fundamentally different practices. Investing typically involves purchasing assets with the aim of holding them for an extended period of time to generate long-term profits. It's like planting a seed and waiting for it to grow into a strong tree that can bear fruits for many years. On the other hand, trading involves buying and selling assets more frequently, with the aim of making profits from short-term market fluctuations. It's more like catching a fish in a fast-moving river, where you need to react quickly to the ever-changing currents to seize opportunities. While trading can be a potentially lucrative practice, it requires a significant amount of knowledge, experience, and skill. Successful traders need to stay up to date with the market trends and have a deep understanding of market dynamics. They also need to be disciplined and able to manage their emotions, as trading can be a highly stressful and emotionally charged activity. Investing, on the other hand, is typically a more passive approach to generating wealth. It's a long-term game that requires patience, discipline, and a solid investment strategy. Instead of trying to make quick gains from market fluctuations, investors focus on building a diversified portfolio that can weather the ups and downs of the markets over time. While both trading and investing can be profitable, they require different skill sets and approaches. Trading is more suited to experienced investors with a high tolerance for risk and a deep understanding of the markets. Investing is generally considered a more reliable way to build wealth over time, but it requires patience, discipline, and a long-term perspective. Understanding the difference between these two practices is crucial for anyone looking to navigate the world of finance and make informed decisions about their investments. Now, let's delve into the second key difference between trading and investing: the analysis. To grasp how the analysis of a company and its stock price differs between traders and investors, we first need to define the distinction between a stock's price and its intrinsic value. The price of a stock is simply the amount of money that buyers and sellers are willing to pay for it at any given point in time. The intrinsic value, on the other hand, represents the true worth of the stock, based on the underlying value of the company and its future growth prospects. While the price of a stock may deviate from its intrinsic value in the short term, over time, the two tend to converge. Passive investors typically ignore short-term fluctuations in stock prices and focus instead on the rising intrinsic value of the market as a whole. They believe that even if they buy a collection of overpriced stocks, they should benefit in the long term as the market grows. In contrast, active investors attempt to estimate a single stock's intrinsic value so that they can buy the stock for less than what they believe it's worth. By doing so, they are attempting to benefit from the rise in intrinsic value of the company, and also from their belief that the discounted price will eventually converge closer to its intrinsic level. Traders, however, have a different mindset altogether. They focus solely on the price of the stock, with no concern for its intrinsic value. Instead of attempting to estimate the stock's true worth, traders look to take advantage of short-term price swings or trends. This often involves using technical indicators, such as graphs and charts that track historical pricing information to identify patterns that they can quickly exploit. Traders may also incorporate qualitative information, such as news announcements or rumors, to try and profit from short-term price movements. While some traders may use qualitative information in their research, it is usually only to take advantage of short-term fluctuations they expect in the stock's price. Traders generally do not attempt to develop a broader understanding of the company's operations or its long-term prospects. Trading requires a very different mindset from investing. It is fast-paced and operates in a competitive environment where traders often try to hide their true intentions to gain an advantage over other market participants. Some traders may even use bluffing tactics to try and manipulate the price of a stock in their favor. Now, while these tactics may have been more prevalent in the past when traders interacted in person, they still exist today in the digital age. In conclusion, while trading and investing may seem similar on the surface, they are fundamentally different in terms of their approach to analysis, time horizon, and mindset. While trading can potentially offer higher returns in the short term, it is also riskier and requires a different set of skills and knowledge. Investing, on the other hand, may offer lower returns in the short term, but has historically provided higher returns over the long term. I know, it seems like the ultimate dream. A fast-paced and competitive environment with the promises of potential, quick, and large financial gains. But before you start picturing yourself as a millionaire with a private jet, let me tell you, trading is not a walk in the park. It is a high-risk practice that requires a lot of money and time. And the truth is, it's not really stacked in the favor of amateur traders. I mean, sure, we've all seen the online ads with people claiming they went from being broke to becoming highly successful traders with millions in their trading portfolio with the simplest strategies. But the reality is that most traders place large bets, sometimes even trading on margin, which further increases the risk of potential massive losses should the market not move in their favor in the short term. So, while trading might seem like an alluring practice, especially for young investors, you need to be careful. It's not as easy as it seems, and the risks are high. Don't get me wrong, trading can be a lucrative career, but it takes a lot of skill, experience, and discipline to succeed. So before you jump in headfirst, make sure you do your research and understand the risks involved. The competition is fierce. Speed of execution is critical, and you're often making decisions based on incomplete information when it comes to trading. You're up against seasoned pros who have all the advantages: money, resources, and even algorithms that can execute trades in the blink of an eye. It's like going into a game of poker with a bunch of sharks. And let's be honest, the odds are not in your favor. Let's get this straight. There are some very successful traders who do it for a living, but there are many more that failed at building a sustainable and profitable practice. It's important to remember that trading is a lot like gambling. You can be skilled and experienced, but there's always an element of chance involved. And when you're playing against top-notch opponents, the odds are even lower. That's why many financial advisors recommend investing over trading. For the average person, by doing your research, investing in a diversified portfolio of stocks, and holding over the long term, you're more likely to benefit from the overall growth of the economy and the stock market. It may not be as thrilling as a high-risk, high-reward trade, but it's a safer and more sustainable way to build wealth. You hopefully now know a little more about the difference between trading and investing, and we really hope you found the information helpful and informative. If you have any questions or comments about the topic we discussed, please leave them in the comments section below. We always love to hear from our viewers, and we appreciate your feedback. If you've enjoyed the video, please hit the thumbs up button, subscribe, and hit the notification bell so you never miss out on more financial tips and insights. Thanks again for watching, and we'll see you in the next video.